Tutorial 5. Lending Policies and Procedure 1. A lending institution must ensure that its loans meet regulatory standards. Therefore, banks should establish a loan policy that serves as a guideline for making individual loan decisions and shaping the overall loan portfolio. Interpret the important elements of a well-written loan policy. Important elements of a well-written loan policy. A well-written loan policy ensures that lending activities comply with regulatory standards while maintaining profitability. It provides clear guidance for loan officers and requires regular review to remain effective in a changing environment. 1. Clear lending objectives and portfolio alignment. A good loan policy must define the overall goals of the loan portfolio, including types, sizes, maturities, and quality of loans. This ensures lending decisions are consistent with the bank's strategy and risk tolerance while maintaining a balanced portfolio. For instance, a bank may focus on SME and housing loans while limiting high-risk lending to ensure stable returns. 2. Defined lending authority and responsibility. The policy should clearly specify the authority of each loan officer and committee, including approval limits and required authorization. It must also outline responsibilities for decision-making and reporting. For instance, smaller loans may be approved by branch officers, while larger loans require approval from a credit committee. 3. Standardized credit evaluation and operating procedures. A well-written policy must include procedures for evaluating and approving loan applications. It should outline borrower assessment criteria and required documentation, ensuring consistent and fair decisions. For instance, banks may require financial statements, cash flow projections, and supporting documents before approving loans. 4. Collateral, pricing, and risk management guidelines. The policy should provide guidelines for evaluating collateral, setting interest rates, and defining repayment terms. It must also include quality standards and limits, such as loan-to-asset ratios, to control risk and ensure profitability. For instance, higher-risk borrowers may be charged higher interest rates or required to provide strong collateral. 5. Monitoring, review, and compliance control. The policy must include procedures for monitoring loan performance and ensuring compliance with regulations. Regular reviews help identify risks and improve policy effectiveness. For instance, banks may review loan portfolios periodically and adjust policies if default rates increase. A well-written loan policy supports consistent decision-making, effective risk management, and regulatory compliance, helping maintain a stable and profitable loan portfolio. 2. The credit department of a bank is responsible for analyzing loan applications and making recommendations on whether to approve them. Interpret what actions must be taken to verify a customer's creditworthiness to ensure the bank makes sound lending decisions. The credit department is responsible for analyzing loan applications and ensuring that borrowers are creditworthy. To make sound lending decisions, the department must evaluate whether the borrower can repay the loan, whether the loan is properly structured, and whether the bank can recover funds in case of default. Several key actions are involved in this process. 1. Finding prospective loan customers. The bank identifies potential borrowers through marketing, referrals, or existing customer relationships. This step ensures that the bank attracts customers who meet its lending criteria and business objectives. For example, a bank may target small business owners with stable income to expand its SME loan portfolio. 2. Evaluating character and sincerity of purpose. The bank assesses the borrower's character, including honesty, responsibility, and willingness to repay the loan. It also evaluates the purpose of the loan to ensure it is reasonable and aligns with the borrower's financial situation. For example, a borrower with a good repayment history and a clear business purpose is considered more reliable. 3. Making site visits and evaluating credit record. The bank may conduct site visits to verify the borrower's business operations and assess their credit record. This helps confirm the accuracy of information provided and evaluate the borrower's reputation with other lenders. For example, visiting a business premises allows the bank to confirm its existence and operational condition. 4. Evaluating financial condition, capacity, and capital. The credit department evaluates the borrower's ability to repay the loan by analyzing income, expenses, assets, and liabilities. This includes assessing capacity, repayment ability, and capital net worth. For example, a permanent employee earning RM6000 per month with manageable existing commitments shows good repayment capacity. 5. Assessing collateral and signing the loan agreement, the bank evaluates the collateral offered to secure the loan and ensures that the loan agreement is properly structured and documented. Collateral protects the bank in case of default, while proper documentation ensures legal enforcement. For example, property may be used as collateral for a housing loan to reduce lending risk. 6. Monitoring compliance and customer relationship. After the loan is approved, the bank monitors the borrower's compliance with the loan terms and repayment schedule. It also maintains ongoing customer relationships to identify any potential risks early. For example, the bank may review repayment performance regularly and take action if payments are delayed. Conclusion. In conclusion, verifying a customer's creditworthiness involves a systematic process of evaluation, approval, and monitoring. These steps help reduce risk, ensure proper loan management, and support the bank in making safe and profitable lending decisions. 3. The credit department of a bank plays an important role in analyzing a customer who makes the loan application. There are several steps in the lending process which banks need to do before approving a loan. Illustrate the lending process, which will be carried out by bank. The credit department of a bank plays an important role to analyze a customer who makes the loan application. There are several steps in the lending process which banks need to do before approving a loan. Illustrate the lending process which will be carried out by bank. Lending process carried out by the bank. The credit department of a bank plays a vital role in evaluating loan applications to ensure loans are granted responsibly and in line with policies. Before approval, the bank follows a systematic lending process to minimize risk and ensure the borrower can repay. Lending process carried out by the bank are as follows. 1. Loan application. The process begins when the customer submits a completed loan application with supporting documents such as identification, salary slips, bank statements, or business financial records. This allows the bank to gather essential information about the borrower's background, income, employment, and loan purpose. Example: a housing loan applicant submits proof of income and property details. 2. Credit investigation and verification. The bank verifies the accuracy of the application by checking credit history, confirming employment, and validating income sources. This helps assess past repayment behavior and identify risks such as defaults or high debt. Example: the bank reviews the applicant's CCRIS report for overdue loans. 3. Credit analysis and risk assessment. The credit department analyzes the borrower's financial position, including income, expenses, debts, and collateral if the loan is secured. Ratios such as the debt service ratio, DSR, are used to evaluate repayment capacity and risk. Example: if income can cover the installment, the risk is manageable. 4. Loan approval and documentation. The application is submitted to authorized officers or a credit committee for approval. If approved, the bank prepares legal documents outlining loan terms, interest rate, repayment period, and installment amount. The borrower signs these documents to formalize the agreement. Example: signing a mortgage agreement confirms repayment obligation. 5. Loan disbursement and monitoring. After documentation, the bank disburses funds to the borrower or relevant party. The bank monitors repayments and takes early action if issues arise, such as reminders or restructuring. Example: the bank contacts the borrower if an installment is missed. Conclusion: the lending process, application, verification, assessment, approval, and monitoring, reduces credit risk, ensures compliance, and maintains a healthy loan portfolio while supporting borrowers' needs. 4. The credit department of a bank analyzes and involves a detailed study of the critical aspects of a loan application. There are 6 criteria to be considered. Illustrate all criteria of a borrower before being granted a credit. 6 criteria of a borrower before being granted credit. When a customer applies for a loan, the credit department must conduct a thorough analysis of the borrower's financial condition and risk profile. To make sound lending decisions, banks apply 6 important criteria, commonly known as the 6 Cs of credit. 1. Character. Character refers to the borrower's honesty, integrity, and willingness to repay the loan. The bank evaluates this through credit history, past repayment behavior, and overall reputation. For example, an applicant with no overdue loans shows trustworthiness and financial responsibility. 2. Capacity. Capacity is the borrower's ability to repay the loan based on income and cash flow. The bank assesses employment stability, monthly income, and existing financial commitments. Example: a permanent employee earning Rm6000 per month with manageable existing commitments shows good repayment capacity. 3. Capital. Capital represents the borrower's financial strength and personal investment. It shows how much of their own assets are committed to the project, reflecting responsibility and reducing risk. Example: a business owner investing personal savings to expand a business reflects strong financial backing and responsibility. 4. Collateral. Collateral is an asset pledged to secure a loan, providing protection for the bank in case the borrower cannot repay. If repayment is not made, the bank can sell the asset to recover the outstanding loan. Example: in a housing loan, the property purchased serves as collateral. If the borrower defaults, the bank can sell the property to recover the loan. 5. Conditions. Conditions refer to external factors affecting repayment, such as economic conditions, industry trends, and government policies. The bank ensures the economic environment supports stable income and business growth. Example: lending to a tourism business during an economic downturn may carry higher risk due to unstable market conditions. 6. Control. Control relates to compliance with legal and regulatory requirements. The bank ensures the loan follows central bank regulations and internal policies, and that the loan purpose is lawful. Example: the bank will not approve a loan for illegal activities and must ensure the loan complies with lending limits. The 6 Cs of credit provide a complete framework for evaluating borrowers. By analyzing these criteria, banks assess reliability, financial strength, and risk, ensuring responsible lending and reducing potential financial losses. Tutorial 6. Lending to business firms and pricing business loans. 1. Discuss 5 types of short-term business loan. Short-term business loans are designed to meet a company's temporary funding needs, usually lasting from a few days up to 1 year. These loans help businesses manage cash flow, purchase inventory, and support daily operations. Below are 5 common types. 1. Self-liquidating inventory loans. A self-liquidating loan finances inventory, raw materials, or finished goods. The loan is repaid when the goods are sold, generating revenue to settle the debt. Example: a clothing manufacturer may take a loan to produce seasonal products and repay it after sales. 2. Working capital loans. These loans provide funds for daily business operations rather than long-term investments. They are used to pay suppliers, wages, or purchase materials. Example: a retail business may use a working capital loan to prepare for peak sales periods. 3. Interim construction financing. This type of loan funds construction projects such as buildings or apartments. It covers costs like labor, materials, and equipment until long-term financing is secured. Example: a constructor may use this loan while waiting for a mortgage loan. 4. Security dealer financing. These loans are provided to securities dealers or investment firms to finance the purchase of financial instruments like stocks or bonds. The loans are usually secured by the securities themselves. Example: a brokerage firm may use financing to support bond issuance or margin trading. 5. Asset-based financing. Asset-based loans are secured by short-term assets such as inventory or accounts receivable. Lenders may also provide services to manage and collect receivables on behalf of the company. Example: a company uses its receivables to obtain immediate cash flow. In conclusion, short-term business loans are essential for maintaining liquidity, managing operations, and supporting temporary financial needs. Choosing the right loan type helps businesses optimize cash flow and reduce financial risk. 2. Discuss 4 types of long-term business loan. Long-term business loans are financing options with maturities exceeding 1 year, used to support major investments, acquisitions, or large-scale projects. These loans help businesses purchase fixed assets, facilities, and fund strategic growth. Banks carefully evaluate borrowers to reduce risk. Below are 4 common types. 1. Term loans. Term loans finance the purchase of equipment, machinery, or physical structures. Repayments are scheduled based on cash flows and may be made in installments or at maturity. These loans are usually secured by fixed assets. Example, a manufacturing firm borrows to purchase new machinery. 2. Revolving credit facility. A revolving credit facility allows borrowers to draw, repay, and redraw funds repeatedly up to a set limit over time. It provides flexibility and supports ongoing investments or projects. Example, a construction company uses it to finance different project phases. 3. Project loans. Project loans finance large infrastructure or industrial projects expected to generate future income, such as power plants or refineries. They involve higher risk due to large funding needs and uncertainties. For example, banks provide funding for a power plant project, which is repaid using the revenue generated from electricity production. 4. Loans for business acquisitions. These loans are used to acquire companies or business units, supporting expansion and mergers. They are often funded by a group of lenders because large amounts of money are needed. Example, a firm borrows to acquire a competitor and expand market share. By evaluating loan type and borrower profile, banks can structure long-term loans that support growth while minimizing risk. 3. List 4. 4. Methods used to price the business loan. 4 methods used to price a business loan. 1. Cost plus loan pricing method, markup. The bank determines the loan rate by adding a profit margin to the cost of funds. This ensures the bank covers its funding cost while earning a return. Example, if the bank's cost of funds is 4% and it adds a 2% markup, the loan interest rate will be 6%. 2. Price leadership model. In this method, the bank sets its loan rate based on the leading bank or market leader's rate. Other banks follow this rate to remain competitive in the market. Example, if the leading bank offers a 5% rate, other banks may price similar loans close to this level. 3. Below prime market pricing. Banks may offer rates slightly below the prime lending rate to attract desirable or high-quality borrowers. This method is often used to gain market share. Example, a bank offers a new corporate client a loan at 4.5% when the prime rate is 5%. 4. Customer profitability analysis. The bank sets the loan rate based on the overall profitability of the customer relationship, considering other products, fees, and long-term value. High-value customers may receive preferential rates. Example, a long-term corporate client with multiple accounts and loans may be offered a lower rate to maintain the relationship. Conclusion, by using these methods, banks can price loans to cover costs, remain competitive, manage risk, and maintain profitable customer relationships. 4. What is the information needed to price the business loan if it uses cost-plus loan pricing? Information needed to price a business loan using cost-plus method. When a bank uses the cost-plus loan pricing method, it calculates the loan interest rate by adding all costs and desired profit. The following 4 components are essential. 1. Cost of raising funds, marginal cost of loanable funds. This is the interest cost the bank incurs to obtain the money it will lend to the borrower. It includes funds borrowed from the money market, interbank loans, or deposits. A precise estimation ensures the bank covers its financing. 2. Non-fund operating costs. These are all administrative and operational expenses involved in analyzing, processing, approving, and monitoring the loan. This includes staff salaries, documentation, legal checks, and monitoring systems. Accounting for these costs ensures the bank's operations are sustainable. 3. Estimated risk premium. To compensate default risk, the bank adds a margin to cover the possibility that the borrower may default. This premium depends on the borrower's creditworthiness, industry risk, and project stability. It helps protect the bank from potential financial losses. 4. Desired profit margin. The bank includes a profit component to ensure the loan generates returns above all costs and risks. This margin reflects the bank's target profitability and contributes to its long-term financial performance. Formula loan interest rate equals marginal cost of raising loanable funds to lend to borrower plus non-fund bank operating costs plus estimated margin to compensate bank for default risk plus bank's desired profit margin by combining these four factors. The bank can set a loan rate that covers costs, compensates for risk, and ensures profitability, making lending safe and sustainable. 5. Write the formula for the price leadership model. Price leadership model. The price leadership model is used by banks to set loan interest rates based on a leading bank or market benchmark. Banks follow the leader rate to remain competitive while adjusting for borrower-specific risks. Formula: loan interest rate equals base or prime rate plus default risk premium for non-prime borrowers plus term risk premium for longer-term credit, for example. If a medium-sized business applies for a 3-year loan to purchase new equipment, and the prime rate is 6% with an additional 2% for default risk and 2% for term risk, the annual loan interest rate would be calculated as 10%, 6% plus 2% plus 2%. Explanation: black base or prime rate, the starting point for pricing, usually set by the market leader or central bank benchmark. Black default risk premium for non-prime borrowers, an extra margin added if the borrower has a higher risk of default. Higher risk borrowers pay more. Black term risk premium for longer-term credit, additional interest charged for longer-term loans to compensate for the uncertainty and potential changes in market rates over time. This model allows banks to maintain market competitiveness, price loans fairly based on borrower risk, and manage interest rate risk for longer-term lending. 6. A bank determines the loan price using the cost-plus pricing method. The bank estimates cost of funds equals 4% operating costs, 2% risk premium equals 1.5% profit margin equals 1% I. Calculate the interest rate that the bank will charge on the business loan. Roman 2. If the business borrows RM 200000, calculate the annual interest charged. Given, black cost of funds equals 4% black operating costs equals 2% black risk premium equals 1. 5% black profit margin equals 1% black loan amount equals RM 200,000. I calculate the interest rate using the cost plus loan pricing formula. 3 marks. Loan interest rate equals marginal cost of raising loanable fund plus no fund bank operating cost plus estimated margin to compensate bank for default risk plus bank desired profit margin / text loan interest rate equals 4% plus 2% plus 1. 5% plus 1% equals 8. 5%. Answer: 8.5% per year. Roman 2. Calculate the annual interest charged. Annual interest equals loan amount times interest rate. Annual interest times 8.5% times 0.085. Annual interest equals RM 17000. Answer: RM 17000 per year. White heavy checkmark. Summary: black loan interest rate equals 8.5%. Black annual interest on RM 200000 equals RM 17,007. A business customer is offered a loan at prime rate plus 2%. The current prime rate is 5.5%. I. Calculate the interest rate charged to the business borrower. Roman 2. If the loan amount is RM 300,000, calculate the annual interest payment. Given, prime rate equals 5.5%. Loan offered at prime rate plus 2% loan amount equals RM 300,000. I. Calculate the interest rate charged. Interest rate equals prime rate plus additional margin. Interest rate equals 5.5% plus 2% equals 7.5%. Answer: 7.5% per year. Roman 2. Calculate the annual interest payment. Annual interest equals loan amount times interest rate. Annual interest equals RM 300,000 times 7.5% equals RM 300,000 times 0.075. Annual interest RM 22500 per year. White heavy checkmark. Summary: interest rate equals 7.5%. Annual interest equals RM 22500. Tutorial 7. Consumer Loans, Credit Cards and Real Estate Lending 1. Explain credit card. 10 marks. Credit cards are a widely used form of consumer credit that allows users to borrow funds up to a pre-approved limit. Borrowers can repay in full or through installments, making it a convenient tool for purchases, cash withdrawals, and bill payments. Banks earn revenue from credit cards primarily through interest on outstanding balances, which usually range from 10% to 24% or higher. Customers who choose installment plans generate more profit due to accumulated interest, while merchants also pay discount fees of 17% on card sales, contributing to the lender's earnings. Credit cards provide a revolving line of credit, offering flexibility, but they also carry risks such as default and fraud if repayments are not managed properly. The market is dominated by major players like Visa and MasterCard, with banks offering competitive promotions, such as low-interest or no-interest plans, which later revert to standard higher rates. Additionally, improper usage can lead to accumulating debt due to high interest charges and minimum payment traps. 2. Illustrate the characteristics of consumer loans. 10 marks. Consumer loans are designed for individual borrowers and have several distinct characteristics that differentiate them from other types of lending. These loans support personal financial needs such as education, vehicles, and daily expenses. One high cost and risk consumer loans are typically expensive and risky because they are often unsecured. Lenders charge higher interest rates and include risk premiums to cover possible defaults and administrative costs. Example, personal loans usually have higher interest rates than housing loans because there is no collateral involved. Too sticky interest rates and cyclical demand interest rates on consumer loans are usually fixed, sticky, and do not adjust quickly to market changes, exposing lenders to interest rate risk. Demand is also cyclical, increasing during economic growth and decreasing during downturns. Example, more people apply for car loans during economic expansion, but borrowing declines during a recession. 3. Borrower behavior and income influence. Borrowers often focus on monthly payments rather than total loan cost. Income and education levels also affect borrowing patterns and credit usage. Example, a borrower may choose a longer repayment period to reduce monthly payments, even if it increases total interest. Overall, consumer loans combine profitability for lenders with flexibility and risk management considerations, reflecting both economic conditions and borrower characteristics. 3A. A customer borrows $5,000 for 1 year at a simple interest rate of 5% to purchase some office equipment. Calculate the total payment amount inclusive interest. Given, principal P equals $5,000, interest rate R equals 5% per year, time T equals 1 year. Simple interest, SI, equals principal times rate times time equals P times R times T equals 5,000 times 5% times 1 equals 5,000 times 0.05 equals 250. Total payment equals principal plus interest equals 5,000 plus 250 equals 5,250. Answer. Total payment after 1 year equals $5,250. 3B. Refer 3A. Now assume the customer is allowed to pay off the loan principal in half-yearly installments of $2,500 each. Compute the total payback amount. Since the customer repays half of the principal every 6 months, interest is charged only on the outstanding balance for each period. Step 1. First installment, first 6 months. Outstanding principal equals $5,000 interest for 6 months, principal times rate times time, equals 5,000 times 5% times 612 equals 5,000 times 0.05 times 0.5 equals 125. First installment payment equals principal repaid plus interest equals 2,500 plus 125 equals 2,625. Step 2. Second installment, next 6 months. Outstanding principal after first repayment equals 5,000, 2,500 equals 2,500 interest. For 6 months, 2,500 times 5% times 0.5 equals 62.5. Second installment payment equals principal repaid plus interest equals 2,500 plus 62.5 equals 2,562.5. Step 3. Total payback amount. Total payback equals first installment plus second installment equals 2,625 plus 2,562.5 equals 5,187.5. Answer. Total payback amount equals $5,187.50. First half interest equals principal x rate x time equals 5,000x, 5% x 12 equals $2,625. Second half interest equals principal x rate x time equals 2,500x, 5% x 12 equals $2,562.50. Total payment equals $2,625 plus $2,562.50 equals $5,187.50. 3C. A customer was offered a loan of $5,000 at the rate of 5% for a year. Using the discount rate method, compute the loan amount to be received by consumer, loan amount to be repaid to bank, and effective loan rate. Given, loan nominal value equals $5,000, discount rate equals 5%, time equals 1 year. Step 1. Calculate the amount the customer actually receives, proceeds. Using the discount method, the interest is deducted from the principal at the start. Loan amount received equals nominal loan times 1. Discount rate times time. Loan amount received equals 5,000 times 0.05 times 1 equals 5,000 times 0.95 equals 4. 750. Step 2. Calculate the total repayment the customer repays the full nominal value at maturity. Loan amount to be repaid equals nominal loan equals 5,000. Step 3. Calculate the effective interest rate. Effective loan rate equals interest paid. Amount received times 100 interest paid equals nominal loan. Amount received equals 5,000. 4,750 equals 250. Effective loan rate equals 250 divided by 4,750 times 100, approximately 5.26%. Answer. Black loan amount received by the customer equals $4,750. Black loan amount to be repaid to the bank equals $5,000. Black effective interest rate equals 5.26%. 3D. A consumer has a loan which to be repaid in 1 year, 12 monthly installments, but he repaid the loan after 10 months. Estimate the interest rebate using Rule 78. Step 1. Total of digits. Total of digits for 12 months equals 12 times 12 plus 1. 2 equals 12 times 13 divided by 2 equals 78. Step 2. Sum of digits for remaining months. Remaining months equals 12. 9 equals 3 months. Sum of digits for remaining months equals 3 plus 2 plus 1 equals 6. Step 3. Rebate fraction. Rebate fraction. Sum of remaining months, total of digits equals 6 divided by 78, approximately 0.0769. 2. Step 4. Calculate rebate interest. Rebate equals rebate fraction times total finance charge equals 0.07692 times 1,200, approximately RM 9231. Step 5. Interpretation. The customer gets back RM 9231 as an interest rebate, which is about 7.7% of the total finance charge for settling the loan early at month 9. 3E. A borrower seeks for RM 40,000 home loan with a loan rate of 6.75%. The tenure of the loan is 30 years. Calculate the monthly mortgage payment. Given, black loan amount P equals RM 400,000. Black annual interest rate R equals 6. 75% black loan tenure N equals 30 years. Right arrow 360 months. Step 1. Convert annual rate to monthly rate. Monthly interest rate equals annual rate. 12 equals 6.75%. 12 equals 0.5625%. Equals 0.005625 in decimal. Step 2. Total number of monthly payments. Total payments equals 30 times 12 equals 360. Step 3. Use the mortgage formula. Monthly payment equals P times R times 1 plus RN. 1 plus Rn, 1 plug in the values. Monthly payment equals 400,000 times 0. 005625 times 1 plus 0. 005625 360. 1 plus 0. 005625 360. 1 Step 4. Calculate 1 plus Rn, 1 plus 0. 005625 360 approximately 7.517. Using compound interest formula, Step 5. Calculate monthly payment. Monthly payment equals 400,000 times 0. 005625 times 7.517. 7. 517. 1. Monthly payment equals 400,000 times 0.04227. 6.51. 7 approximately 16,908. Divided by 6.517, approximately Rm2594. Answer. The monthly mortgage payment is approximately Rm2594. Lecture 5. Lending Policies and Procedure 1. 5 types of loans. Loans are financial arrangements where a lender provides money to a borrower with the expectation of repayment over time, usually with interest. Different types of loans are designed to meet various personal and business needs. 1. Loans to individuals. This type of loan is provided directly to individuals for personal use, such as purchasing goods or covering expenses. It includes financing for automobiles, appliances, home improvements, and medical costs. Example: a person takes a personal loan from a bank to buy a car or pay for hospital bills. 2. Real estate loans. These loans are secured by property such as land or buildings and are used to finance the purchase or development of real estate. They can be short-term, construction loans, or long-term home mortgages. Example: a family takes a housing loan to purchase a house or an apartment. 3. Commercial and industrial loans. These loans are granted to businesses to support operations such as purchasing inventory, paying salaries, or expanding the business. Example: a small business takes a loan to buy raw materials and increase production. 4. Agricultural loans. These loans are provided to farmers and agricultural businesses to support farming activities such as planting, harvesting, and livestock care. Example: a farmer takes a loan to buy seeds, fertilizers, or farming equipment. 5. Lease financing receivables. In this type, the lender purchases equipment or assets and leases them to customers who pay in installments over time. Ownership may or may not transfer at the end. Example: a company leases machinery from a finance company instead of buying it outright. In conclusion, different types of loans serve different purposes depending on the needs of individuals, businesses, or industries. Understanding these loan types helps borrowers choose the most suitable financing option and manage their financial responsibilities effectively. 2. Explain why lending is regulated in the financial system. Lending is a core function of financial institutions, as it supports economic growth by providing funds to individuals and businesses. However, lending also involves significant risks such as credit defaults, excessive exposure, and financial instability. Therefore, lending is regulated to ensure the safety and soundness of the financial system. 1. Protection and risk control regulation protects depositors and investors by ensuring banks do not take excessive risks with deposited funds. It also limits loan concentration and requires adequate capital reserves to reduce financial risk. Example: a bank must maintain a minimum capital adequacy ratio to ensure it can absorb potential losses. 2. Responsible and fair lending regulations promote responsible lending by preventing loans to unqualified borrowers, reducing default rates. They also ensure fair access to credit by preventing discrimination and supporting financial inclusion. Example: banks are required to assess a borrower's income and credit history before approving a personal loan. 3. Transparency and financial stability regulations ensure that lending activities are transparent and accountable. This promotes financial stability, strengthens public trust in banks, and reduces the risk of financial crises. Example: banks must publicly disclose non-performing loan ratios and lending policies to regulators and stakeholders. Overall, lending regulations play a crucial role in maintaining financial stability, protecting stakeholders, and ensuring a safe and reliable banking system. Question 2. What is the Basel Framework? Briefly explain its key focus. The Basel Framework is an international set of banking regulations developed by the Basel Committee on Banking Supervision under the Bank for International Settlements, BIS. It aims to strengthen the regulation, supervision, and risk management of financial institutions globally. The key focus of the Basel Framework is capital adequacy, particularly under Basel III, which requires banks to maintain sufficient capital to absorb potential losses and remain financially stable. Another important focus is risk-weighted lending, where loans are assigned different risk levels, ensuring that higher-risk loans require more capital backing. The framework also includes credit concentration limits, typically restricting exposure to a single borrower or group to around 25% of a bank's capital. Additionally, it prohibits certain risky practices, such as lending against a bank's own shares or insider lending. Supervisory tools under the Basel framework include stress testing, on-site inspections, and loan classification systems. Overall, the Basel framework promotes a safer and more resilient global banking system by minimizing risks and enhancing financial stability. 3. Compare the lending regulations between the international, U.S., and Malaysia. Lending regulations vary across jurisdictions, but share similar objectives of maintaining financial stability and controlling risk. At the international level, the Basel framework focuses on capital adequacy, risk-weighted lending, and credit concentration limits, typically restricting exposure to 25% of capital. It adopts a risk-based supervisory approach using tools such as stress testing and loan classification. In the United States, lending is regulated by bodies such as the Federal Reserve, OCC, and FDIC. The U.S. applies strict legal lending limits, allowing banks to lend up to 15% of capital for unsecured loans and up to 25% with secured collateral. It also prohibits loans secured by a bank's own stock and emphasizes detailed credit documentation and regular examinations. In Malaysia, Bank Negara Malaysia, BNM, oversees lending regulations aligned with Basel standards. It imposes the Single Counterparty Exposure Limit, SCEL, of 25% of capital and enforces responsible financing guidelines. Malaysia adopts a prudential approach focusing on affordability assessment, non-performing loan management, and supporting SMEs. 4. How do examiners classify problem loans? Explain the categories. Explain the risk-weighting method used by examiners. Examiners classify problem loans to assess the quality of a bank's loan portfolio and identify potential risks. Problem loans are categorized into 3 main groups: substandard, doubtful, and loss. 1. Substandard loans. Substandard loans have identifiable weaknesses, such as poor repayment capacity or insufficient collateral, but they still have some chance of recovery. These loans are not yet critical but require close monitoring. Example: a borrower misses several payments but still has a stable job and partial ability to repay the loan. 2. Doubtful loans. Doubtful loans have a high risk of default, and full repayment is unlikely. Although some recovery may be possible, the probability is low. Example: a business facing serious financial losses struggles to repay its loan, and its future income is uncertain. 3. Loss loans. Loss loans are considered uncollectible and have no realistic recovery value. These loans must be written off by the bank. Example: a borrower declares bankruptcy and has no assets left to repay the loan. Overall, this classification helps examiners evaluate loan quality, manage credit risk effectively, and ensure banks maintain sufficient financial stability. Lecture 7. Consumer Loans, Credit Cards, and Real Estate Lending 1. Types of consumer loans. Residential and non-residential loans. Consumer loans are designed to meet the financial needs of individuals and families. Consumer loans are also divided into residential and non-residential loans, depending on whether the loan is used for housing or other personal needs. Residential loans, particularly mortgage loans, are used to finance the purchase of homes or property improvements. These loans are typically long-term, ranging from 15 to 30 years, and are secured by the property itself. Borrowers may choose between fixed interest rates, which remain constant, or variable rates that change based on market conditions. A commitment fee of about 1–2% may be required to secure the loan. Residential loans are provided by various lenders, including banks, credit unions, insurance companies, and mortgage institutions. Non-residential loans are used for personal expenses other than housing and are generally shorter in duration. They include installment loans, which are repaid over time through regular payments and are commonly used for large purchases such as cars, furniture, or appliances. Non-installment loans, on the other hand, are short-term and repaid in full amount, often used for expenses like medical bills, vacations, or home repairs. These loans provide flexibility to meet different consumer financial needs. 2. Credit scoring and the FICO system. Credit scoring is a widely used tool by banks, credit card companies, and insurance firms to assess consumer loan applications and manage credit risk efficiently. By automating the evaluation of large volumes of applications, credit scoring reduces labor costs and minimizes bad debt losses, allowing lenders to make faster and more consistent decisions. For customers, this system provides convenience, as loan approvals or denials can often be obtained within minutes via phone or online applications. Scoring models assign numerical values to applicants based on factors such as credit bureau ratings, home ownership, income, deposit accounts, and occupation. Applicants above a predetermined cutoff score are usually approved, while those below may be denied unless mitigating factors exist. The FICO scoring system, developed by Fair Isaac Corporation, is the most widely recognized credit score model. FICO scores range from 300 to 850, with higher scores indicating lower credit risk. The system evaluates 5 main areas: payment history, amounts owed, length of credit history, types of credit used, and new credit inquiries. Tools such as score simulators allow borrowers to estimate how financial changes can affect their scores, helping them improve their creditworthiness before applying for major loans like mortgages. 3. Explain real estate loans, their characteristics, differences from other loans, and how they are priced. Real estate loans are provided by finance companies and insurance companies to fund the purchase or improvement of properties such as homes, apartments, office buildings, shopping centers, and land. These loans can be either short-term construction loans, typically repaid within months, or long-term mortgages that last 25–30 years. Real estate lending has grown rapidly, making up nearly 1/3 of bank assets by the 21st century, but it carries significant credit risk due to the large loan sizes and long maturities. Compared to other loans, real estate loans are generally larger and have longer terms, often ranging from 15 to 30 years for residential mortgages. The extended loan period exposes lenders to risks such as economic downturns, interest rate fluctuations, and changes in the borrower's income or financial condition. Collateral plays a critical role in real estate lending, as the property itself is the primary security. Professional appraisals are necessary to determine the property's value and ensure compliance with industry and regulatory standards. Loan pricing for consumer and real estate loans depends on factors such as interest rate, loan maturity, and repayment schedule. Loan officers work closely with customers to structure repayment terms that meet the borrower's ability to pay while maintaining profitability for the lender. Strong competition among lenders also influences the interest rates offered. Long-term loans have become more common to make higher-priced purchases, like homes and cars, more affordable for borrowers.